Good morning. This is the weekly update of the stock market. It's August 20th. It's 8 a.m. Eastern Time. I'm Rich Possum for Critical Point. Let's begin with a list here of a variety of model trends related to various business cycles as well as other things in the model. And what we'll state is that super cycles 1 through 4, that we can see there was tops in the early 1800s, 1929, which should ring a bell with everyone, 1973 or so, 2000, okay? And then we have bottoms of 1932 through 2000, and a series of them around 2009, which is why this is called cycle series analysis as well as sequential trend analysis. All right, the forecast is that a variety of super cycles are likely to top sometime in 2028 to 2031, and it may even be the most important super cycle that has not been seen since the early 1800s. There is an alternate forecast suggesting these super cycles could top as soon as 26, and it has to do with the timing tool with this LT1 long term. I'll explain in a moment. When we get into the supercycle bear market due around 2030s, but you also notice I'm allowing 2040 or around 2050s. There's a variety of forecasts, two separate models. For many years, I thought it was going to be around 2040. I now think it's going to be around 2030. For most of the scenarios. Most of the scenarios, however, also allow 2040, don't allow 2050. A few scenarios allow 2050, and we actually have a more important bottom doing 2050 to confuse things. Bottom line is we don't have enough history and data to do a good job with decent probability and confidence to pick the supercycle top. It could be either one of 3 decade turning points. But I'm currently playing it safe and favoring 2030, and I think there's enough evidence to actually feel a little bit convicted that we better allow 2030. We could be in the roaring 2020s right now. And what happened during the roaring 20s, 1920s? Well, it ended with a severe bear market of minus 89% for the Dow Jones. Well, this coming bear market, I'm looking for about 40% to 70%. There's even a slight chance it won't be more than 60%. And maybe the Fed can do something here where we don't even have more than a 40% or more. I kind of doubt that if the super cycles are there. If the super cycles are going to delay, then we're probably only looking for about a 20 to 60%, maybe only 20 to 50% drop. Okay, what's timing these? Well, so let's just keep in mind the super cycles are up into 2030 at least. Okay, keep it in mind that the model's saying when you view the clock model and convert it to like a DNA code, it is not similar to 1929. So in theory, it's totally different. Anything goes. We don't know we're actually going to have like a 1929 scenario. As we dig deeper inside a DNA code, there's a component that says there's some similarities to 1929. But with the mechanics of how the Federal Reserve manages things, how we're managing our economy, there's a good chance we're going to come up with new statistics. We're going to manage, or for some of you may prefer to manipulate, meaning you don't like how we run the economy. We can do that so that we don't have so much downside. And I got to tell you, I really question if there will be a 1929 crash ever, and if there is, it may even be beyond the 2100 year mark, because it's quite possible supercycle bottoms are far more important than supercycle tops. So we just don't have enough information here, but it looks like it's saying don't dial in a 1929 crash. But even when we go back to 1800s, we found the same supercycles or more important supercycles really only were 70% drop. So I think we're doing the right thing and not trying not to get too bearish here. But the point is we have to consider it may occur. Now, for the 2050s on to the 2090s, I think we're going to see an easing back in global warming. Maybe we'll even see the end of global warming for thousands of years, but I really doubt it. I'm now more concerned of an extension over the next 1,000, 2,000 years, or at least into next century. But we at least ought to back off some temperature from the smaller super cycles in that, and that can coincide with how we behave. So it may be that we're going to be a better people in the 2050s, 2090s, either by coincidence or some kind of connection to an easing back in temperatures and global warming. Now, at the same time, however, I find totally separate evidence that we may actually be a better people anyways from 2050, 2090s, more stable economy and markets. We may be more socio-capitalistic democracy, and the rest of the world may head in that direction or something similar, variations of it. This may limit upside in the stock market. This may limit how rich anyone can be, but it may also lead to a much happier, fairer system and a calmer, better people, not only in the U.S. but around the world. I also believe we're going to be in a commodity supercycle bear market from 2040s to 2070s, and around 2070s we should be due for something similar like a 2009 bottom in the stock market and economy. So we'll have to watch, in the future generations, we'll have to watch out for that little turning point. That supercycle bear market for commodities can actually help the economy overall and also help calm things down. But it's not going to be due from just oversupply. It's definitely not going to be due from a poor economy, in my opinion. And demand. It's going to be from a massive shift in demand to alternative foods and alternative energies. So keep that in mind. So it looks as though the 2030s, 2050s can be some kind of transitional process. We may have more than one serious bear market. I'm sure some are going to tout that we're on our way to a revolution, civil war. Well, we may see a pickup of those kind of events around the world in terms of global numbers, but we're probably not going to see something like that in the U.S. Well, we could still have more turmoil, but if the Federal Reserve printing money and switching to more of a fiscal policy than monetary policy may help us calm down here as we go through this process. In the meantime, however, we still have a supercycle bull market this decade, and inside of that we have the long-term L1 cycle that last peaked around 2018 or to 2020. I'm saying 2020 for the moment, but I got to look over my shoulder because it may have been 2018. We have far more evidence that the U.S. was starting towards a recession. The world did head towards recession, but the Federal Reserve and its money printing by late 2019 kind of threw a wrench in the machine there, and that's why we may have actually topped in 2020 off of the virus recession. The difference between those two forecasts suggests we want to watch out for a top in 2028 to 2031, but it may occur as soon as 26. Okay. Upside potential is 6,800s to 8,500s for the S&P 500, about 53,700s to 67,300s for the Dow Jones Industrials. Inside of that, we have the LT2 that's probably up into around 2024 to 2026. It'll set back. We may get a secondary recession for a few sectors of the economy. Those of you who did very well, job-wise, business-wise, career-wise during the virus recession may find you're going to take a hit in 2024 to 2026. And of course, we have another election coming up. Current model forecast is Biden will probably get elected again, and we'll continue this trend around. I think this is in the stock market. This LT2 doesn't really work that as well as it does in interest rates, maybe inflation, commodities, and climate, and various macroeconomic data and business statistics. Anyways, I have an upside objective 5100s to 5600s for the S&P 500. It looks as though that's low. We need to do some work on that and revise that probably higher. Now, the next smaller trend is the level T3 bull market. And that last topped in 2020, we know that one for sure. At last bottomed in 2020, we know that one for sure. And I actually bought it within 2 days of the bottom and still hold a position for that, for example. And subscribers were aware of that. The top's probably going to occur next year, perhaps as early as March, but it may not show up until near the end of 2022. The earlier it shows up, the more likely the market can fully recover or move on by the end of 2022. And the next bull market after that would coincide with the LT2, meaning it ought to be still higher by 2024. But for currently into next year, we've raised our objective from around 4,300 to 4,600 to 4,500 to 5,000. And that would be about 35,600s to 39,600s for the Dow Jones. I'm basically just using the same percentage increase. Now, all of these trends break down into level 1, 2, 3, 4, which I'll show you in a few moments on the charts. This is all your intra-year trading, but keep in mind the level 1, even though there's more than one per year, one of those can be the high of the year, one of those can be the low of the year. In addition, we use it for the long-term timing. We have to have a level 1 to go with, say, the LT3. We need an LT3 to go with LT2, and then LT1, and you need an LT1 to go to SC4. This is a clock-like model. We need a variety of hands to come at midnight to show a certain top or bottom, and this clock is also like a missile tracking system. When we come into that, we can also convert this clock-like model to almost like DNA. We can put letters on it and have labels, and that's where I come up with this idea. You know what? Really, the code isn't like a 1929 scenario, but we also know there's a component in there that we could have such an event, and as soon as around 2030. Okay, so we are bullish, okay, but there's always going to be fluctuations, disruptions. You can see all these long-term things are going to cause fluctuations along the way. Basically, the LT3 occurs 4 to 6 times per decade. So you're going to have 4 to 6 upswings, downswings, bull bear markets, and they may not meet Wall Street's definition of bull bear market, especially on the downside. For the bear market, it may not be that deep or serious. It may not be more than 7 or 10% or even 5%. It can be a little bit more than 10%. Now, the LT2 occurs basically twice during a decade, and the LT1 occurs once a decade. The biggest, most important bull bear market per decade. Combine the two for a business cycle, you get one business cycle per decade. Now, it's not exactly a decade. It's around 8 to 13 years, a little less, a little more. Okay, that's its definition. For those who are cyclical enthusiasts and don't like these model names, you're basically looking at the LT1 as a juggler for macroeconomic business side, otherwise a 9-year cycle. LT2 is 5 to 7 or 6-year cycle. LT3 is about a 2 to 4 or about 3 years, a little shorter in my opinion than the kitchen cycle that you can find in cyclical talk. Okay, all right. So that's our long-term scenario, and recently I came across some research of the left-right brain, and there's no question the total market price is an amalgam or the collective soul or mind, if you will, of all people, and it's possible we can treat that as though it was a single person. There's literally a left-right brain in the marketplace for prices. This breaks into that the model is really tracking habitual plus routine task plus creative event, and creative event is actually something different. Whereas the habitual routine task can be thrown in one basket, the creative ought to be on the other basket. That's your left, right, respectively. Okay, and the creative is really more about surprises and how we deal with it, and sometimes it creates noises, problems, complications. However, the pros who've had a long experience sometimes can recognize creative as no more different than a habitual routine task pattern, and they can deal with crashes very well. And my modeling did that last year because we ran 80% accuracy of every other day type patterns that are also related to some intraday patterns throughout the crash and throughout the recovery last year. Many an analyst could not do that. Their models didn't do that. And those managing money showed the performance didn't do that. They were way off the market keeping up, and my model was right on top of it. So very good with that. All right, now, this also coincides with available supply and demand that includes marginal and margin demand supply, and you want to study that marginal. There's even a billionaire out there with a book out how you can have good profits and how you can treat people well and you can run a nice business and get along and have all these rules, almost like the 10 Commandments in religion of how to do good, right? But they discuss that marginal. Well, marginal and margin are very price-sensitive players in the market, and I think that the overall available supply demand as a component of supply and demand is also very price-sensitive. This all helps explain why prices consistently overshoot, undershoot standard fundamentals and economics that only explain about 50% of price fluctuation, but within a range of 20 to 80%. So this model is trying to pick up on the standard fundamental plus the X fundamental that includes just studying market prices and includes all of the above here that I just listed and talked about. And I think tends to favor habitual and routine tasks because it looks like to me all these other concepts just create data points or price points on a chart, and it looks like it's scattered, that there's holes and gaps all over. Well, the market doesn't work that way. It doesn't have that many holes and gaps. It doesn't jump around that much. It will connect all the dots. Well, I want to know, why is it connecting those dots? How is it doing that? And this is where we get into this habitual routine task, because we got to do business day to day. We're looking at day-to-day business, and we're looking at times when people can't keep up with standard fundamentals in economics. They got to do something for themselves, manage their own money, and some of their transactions are not going to coincide with the latest fundamental news headline. And this gives us the more complete or whole picture. So the creative event side is very fascinating, but it gets into the surprise panic sometimes and actually creates noise, even though some of them actually learn to handle and deal with it quite well. Hopefully we're doing a good job of dealing with both, but I kind of favor this habitual. And for those of you who are anti-Fed, I'd like to say this habitual stuff really tells us how the true economy works, because and also related to the stock market. Because if you look at when the Federal Reserve started and then progress to today, current, you can see these patterns working. That LT1, every decade, an economic growth of 7 to 12 years, 1 to 3 years of recession. Do you see the Fed helping or hurting or whatever? You see the stock market rising and then falling, okay? And now, if you then go for the years pre-Fed, meaning the Fed was not around, we find those same LT1 patterns, the same business pattern. For the history of this country, we can find it in English markets and various European markets going back 1700s, 1600s, 1500s. We can convert to commodities and commodity-driven economies, taking us all back 1,000 years, and you see the same pattern. We're going to grow the economy so far, then we're going to screw it up, or it's just going to break on its own, and then we panic, which also makes it worse. Those patterns are still there, live and well. Nothing has changed. So the bottom line is the Federal Reserve adds or takes away from this pattern, may help at times, especially during the bad times, putting a floor under us, and the same for government in general. And so the bottom line, it's really about consumers and businesses, and we, the people, we make that business cycle. So we're going to make it again regardless of what the Fed does. And the model's picking up on that, and that's why we can make forecasts that some people think are crazy, as saying, oh, the economy's going to grow all the way to 2028 to 2031, when they're looking at statistics saying, hey, this stock market is so overvalued, the economy is growing already way too fast, you've printed way too much, it's going to blow up any moment. No, it's not. All right? You need to readjust and reset things to get in line with the true business cycle, because it relates to what we, the people, are doing regardless of Fed or the government. So this is the monthly chart of S&P 500 futures, and it looks like it's working on a negative reversal month here, but the model's saying, no, really, it ought to pop into next month. We'll explain that in a moment. Notice it's following some of our guidelines here for a range of possibilities for the rest of this decade. It's on the low side of this particular range here to here. On the upper side of this little range, these would all be support, and we think it's just going to march higher into next year. For a top in this area, they'll probably pull back towards this lower side of the range here. So we may see anywhere from a 5 to 10 to even 12% setback next year, and then it ought to rebound and move on. Now let's look at the VIX here while I'm on this monthly list, because for some reason I started out VIX as just monthly studies. So even this is under my monthly list. I've converted it to weekly, and we see this massive jump in the VIX here. Yet it's historically not outrageous. It is out of line, so that's a little bit of a concern. I think that relates to the fears over taper, and then things that just made everybody nervous about their profits, since it's been such a profitable year. And that would be Afghanistan, some of the geopolitics, and some of the internal politics and infrastructure and all the other things that's been going on daily just finally weighed on everybody's nerves here, triggered some sell signals. Basically, the VIX should settle back in the next few weeks and give us a chance for some stability here in the stock market. But it does bother me it jumped this amount at this time. It's not quite right, so we want to keep an eye on it. I'm going to switch to the weekly list here now and go to the S&P 500. So we want to talk about the taper, and I just realized I did not update for our 5-week rolling forecast. I don't particularly care that it's not updated. I think I'm just going to leave it as the old-fashioned method here. Basically, This is your taper drop. Now, not only is it the fear of taper, okay, that the Fed's cutting back, this can somehow trickle through the banking system and cause some issues, but you have to remember it can also force the banks to get out there and make more loans and help business. We're really just trying to get off a subsidy here is what's going on. Longer term, the taper should be actually a positive sign that the economy is more stable. All right. Now, but there's also other issues going on here. They're concerned over the federal debt ceiling that we're going to have to deal with in September, I believe. There's seasonal factors in September and October when the stock market's normally down, and then it's normally up by November, December. So there's a lot of little things going on here where I think people finally sold a little too soon here. I wonder if that isn't going to take away from any potential selling in next month. So here's what we've got. This is a level 3 business cycle right here. This is another one. It ought to bottom this week. It may not bottom early next. It ought to be up next week into the following week. And then we'll get another setback and we'll keep zigzagging. But what it really should do is just move higher now into latter half September. We had been as early as Labor Day for a top, and it's now looking like it shouldn't top to latter half September. And then it should dip into the end of September to early October, first half October, and then it should move up into November, December for another level 2 top, but the more important level 1 top. Now last week I told you we could have flipped these level 1, level 2s around, and we were a little concerned of that meaning greater downside in September. That could still occur, but I got a feeling that having them, if you look at this trend here, having them sell so much into that level 1 bottom, having them sell so much this week, could be taking away from potential selling later. We may be correcting this market on the way up here without really creating major breakdowns of this weekly chart. I mean, it's just been incredibly bullish, and for the moment you have not damaged this enough. You got to take this down to 4,200 to 4,000 to show you've really damaged this specific trend here for this year. So my guess is we still have upside potential, maybe up to 45.81, and we got some different objectives, more detailed objectives on the daily chart. My guess is we're looking at a halfway point between from this level 1 bottom into a level 2 bottom here in early October. So I think this market is going to recover. I think this is just temporary selling. Now, there are some quantitative people, maybe they're even qualitative, who have come up with studies of various things going on with the derivatives markets. They call this gamma trading, where they see balances can get out of whack and cause a problem in the market. And then they come up with price levels that if it breaches that level is going to trigger still more problems with related to those imbalances. And I think they're watching for breakdowns of like 42.50 or something like that. To me, that sounds like an old number, like they were touting that number a few months ago. The market's too high to do that. I just don't believe it's going to happen. But it's possible some of this unwinding and rebalancing of some of these positions actually weighed on this market, and that may have been the more important fundamental and X fundamental, far more important than the taper, and it's misleading everyone thinking, oh, they're so worried over the taper, and it really might be just the mechanics and the money flow. Okay, any rate, our best guess is this market has higher to go yet. Into next month, we'll call a signal, take a little bit of profit, but we're now thinking, you know what, the downside may not be severe in September because we're getting rid of some of the weak holders here, that people were really nervous about their profits and they had to sell some. And then ultimately later in this year, we think it's still going to be higher. Now I'm going to flip to the daily chart and zoom in here a bit. And we got a variety of upside objectives here. This one worked to perfection. I even wrote about this in a column. Unfortunately, they may be thinking I was talking about the cash market. Cash market went a little higher than that objective. That's okay. Still looks pretty impressive, but it was meant for the futures, and man, they nailed it. It was to perfection. But the downside was more than I thought we would get. I understand it relative to the news. Not so sure I would have managed anything differently if we had a little greater insight and be on top of it a little bit. The model's assuming the market's trying to forge a level 3 bottom now. It's oversold enough, narrowing spread in the daily stochastic. We just need to get the price higher now. We need to get above the 5-day average and eventually turn that 5-day average up to give us late evidence of a level 3 bottom. And ideally, this market will rally higher than, probably rally through next week even, into early the following week. What we don't know is, can it recover fast enough to take out the current record high? I'm a little suspicious we've made some people even more nervous about the future of the market with this decline. We've kind of cleaned some things up, should make it bullish again, but there might be others who are saying, I don't trust this, and they could sell into this on the way up. I wonder if this won't be a struggle into September, and I'm also concerned it might be a struggle that we might have some problems around Labor Day, even if the top isn't coming in till late September. So I think the sellers have about washed up here. It was just a level 3, but notice this strange pattern that's been going on here. It's not so strange to the model, but we haven't seen it work this well in a very long time. Here's a level 3, no downside. Here's a level 3, a lot of downside. It's almost like it made up for the fact that it didn't have enough downside along the way. They got it too overbought, pushed it too hard. Here's another level 3, pushed it for a very long period of time. I mean, it really should not have gone that long. They really shortened it up. So there's that observation of alternation. Something took a long while, or something with a huge price change. The next occurrence of that, next repeat of that, will probably be on the shorter side. And look at the drama. Okay, not so much here, huge amount here. This is more explainable because this was a very important bottom, one of the most important kind of bottoms during the year, and it came off the more important top. Then we see little downside again. Then we see more downside, but it's not due for an important bottom right now, and I doubt we missed an important top. We're not coming up with anything. All right. The bears are probably thinking, well, it's going down into early October to coincide with my bottom forecast. The bulls, on the other hand, are thinking, no, it ought to go up yet into September. Then maybe we can correct. I think we're going to get both on the same page. And what did I warn you last week into the early part of this week? The bulls started up first, shoving the market higher. The bears were not yet done selling, and were not yet on the same page that the market could rally for a little while. The bears started to win this week, but with the taper information and what I think probably is some unwinding inside the market here, the mechanics of the money flow, these positions, that made it even worse. And then the technical selling, the profit taking, made it still worse. Okay, I think you damaged some bulls, you scared some bulls to jump on board with the bears. Now I'm hopeful they're both going to come on the same page here and start this next leg higher. So I got to be bullish, at least in the late next week, if not into early part of the following week. I got to try to be bullish here into September, some kind of setback, then bullish into November. All of these are twists and turns and legs within a minor bull market into next year. That's also part of this bull market for this decade. Okay, now we need to look at some of the outside markets quickly here. We have the 10-year note really doing nothing. It should move higher price-wise into October. That means lower interest rates. Then it should come down some. I think we're looking at a lot of trading ranges here for interest rates and bond prices right into next year. The slight bias of this is we ought to keep the rates on the lower side here for a while. Then later this decade, we will put rates up for bull markets and supercycle, even bull markets, maybe for the next couple of decades. And the same for inflation. I think we'll see inflation back off, and we're going to see some of the commodities back off. So I don't have a lot of trading ideas for you in the bond market here. I don't think a lot is going to happen. I think the bond market is wondering, why is the stock market getting so crazy? No need to do it. And there's some beautiful articles being written that the bond market may be more lenient towards the idea, hey, let's deal with inequality and don't get so caught up about making the stock market so profitable. Don't get caught up about making the rich richer. Anyways, here's the dollar index. Clearly, it's on its way higher until level 1 top, late September into early October. I'm still not sure I understand this bullish phase here, right? And I'm still trying to be a long-term bear over the next few years, but I've warned you can have up to a year at a time of the dollar correcting to the upside, giving trading ranges before it resumes a major long-term bear market. But I do think looking out late October and November, the dollar index will come back down some, okay? I think a violation of this week's low would be a little bit of a warning sign for bulls, and violation of low of 2 to 3 weeks ago would mean we better do a readjustment, reevaluation. Something's wrong. That is, if it does that before we achieve our level 1 time target. Price-wise, we really don't have much for time targets. We're looking a little over 94, but at this pace, it looks like we're too low on that objective. In the gold market, yes, if this year's low is violated anytime now into mid next year, then we want to, or anytime next year even, we want to be major long-term bears for the next 3 to 7 years for the gold market. That doesn't mean it goes down all that time. It probably just means trading range. And I do think there could be some bullish possibilities later this decade, and I'm a super cycle bull into next decade, but I don't think people need gold anymore. I don't think it's really going to work that well. On a shorter term basis, I would like to see a little dip next week, and I'm wondering, will they retrace some of this and kind of test this yet again? And of course, if they do that, we have to be concerned, is the low of the year going to hold? Otherwise, there is a chance that this market can actually rally into late 2022 to early 2023 and at record high, and could do another record high. And then what we can do is become more serious about the major long-term bear, but we'll also shorten that time frame to about 3 to 5 years of bearishness. Okay, we go to Bitcoin now, and basically still looking for a level 1 top, a pullback, and level 2 bottom. We don't know, we don't have downside objectives, so this is not telling you of a big down move coming in Bitcoin, and it's certainly overbought on the weekly stochastic. It can roll over. We have no more insight in Bitcoin because it really doesn't have fundamental economics. And it doesn't even tie with currencies very well. It's its own market. Here's crude oil doing what it was supposed to. I think we've caught the level T, the LT3 minor super or long-term top. I think we're going to be correct of lower energy prices into next year. I think this is a good sign. Commodity indexes are going to roll over, and commodities in general are going to roll over, be lower, and that's going to ease back the inflation rate, but we're still going to wind up with a positive inflation rate. Things will still get more expensive in the store, just not as fast as this year. And at least for those who study the inflation rate, it is a down move. Okay, we've started some kind of bear market in the inflation rate and somewhat for interest rates, but the point is it's probably just a bit of a retracement before going higher later. All right, I think that's it for the outside markets here. Not a lot going on. I think the stock market is basically in its own world right now, doing its own thing. Longer term, though, that fits within a bull market for stocks and a growing economy this decade. Here's the some of the global markets. The India stock market should rally into next year for a 3-year cycle, or the kitchen macroeconomic, or what the model says is an LT3. It's basically saying it's coinciding with the U.S., and I'll be as fast as I can. Same story, higher into next year, right along with U.S. for the German DAX stock market index. Here's the French CAC. Stock index should be higher into next year as well. Don't know how well it'll perform. It's performed very well right at the moment, but I wonder if it won't stall out a little bit. We then have to go to the Spain index, probably higher, still fighting. Some of the socialistic side is holding them back, according to some investors. I think that's an overreaction. Here's the Nikkei stock index, not doing so well. Should pop a bit, I think, but it's probably about as high as it's going to go into next year. It'll coincide somewhat with the U.S. market. So lower confidence here in the Nikkei. I don't think this is a sign of trickling through the global market system and towards the U.S. yet. I think it's really just Japan. Now, let's switch over and see if I got the right chart of China, because I seem to have too many charts of what we're doing for China. They definitely have had some restrictions, complications. Some stocks have been really hammered, so I'm not sure why this chart is holding up so well here, but it's the best we got right at the moment. It's a Shanghai composite, but it's also going to come into a top next year. Some of these I wouldn't rule out topping in the fourth quarter here. So I think personally I still prefer, even though I realize there can be some opportunities to make more money in foreign stocks than the U.S. here, kind of feel like, hey, with this coming signal next year, I think I'd rather just stay with the U.S. at this moment. And what else do we have going on here? I think this is, here's Canada. Got to talk about Canada more. Don't like this particular setback right now. And yet we're still picking up ideas that it ought to be higher, at least in September, to be in line with the U.S. It's quite possible we need to focus more on the rally up to November, that it might give us some complications here through September and early October before moving higher in later this year, in other words, to be in line with the U.S. market. Okay, that's all we've got going on here for the markets. I hope you have, this is a gold market, by the way. Anyways, let's see what we can get out of this stock market here. I think ultimately it's time for them to wrap up this selling and to get moving here for the S&P 500, NASDAQ, and the Dow Jones Industrials. And I think if the futures trade above the overnight high, if cash looks supportive, looks really good, if it trades over yesterday's high, I think that's also a good positive sign here near term for the U.S. stock market, if not the global markets. Past results are not necessarily indicative of future results. Have a great weekend. Stay safe, stay healthy, get vaccinated, wear masks. Thank you.